It sounds like your overall take is that consensus estimates for comps, especially in casual dining, are too low. The question is how low, right?
That's right. When it comes to casual dining, the stocks have come a long way, but it's interesting that the street numbers really haven't come up as much. When you think about the combination of factors out there, the GDP growth that's happening, and Hyman and team here at Evercore, they think you could be looking at nominal GDP growth of 15% in 22 versus 2019. Oftentimes we'll look at 2019 as the base year of a recovery. Well, who's to say we might not get way past that, especially when a lot of these chains have added off-premise business and their competitors are closing stores lately. So, but we're going to need to see those upside scenarios for the stocks to work. So it's going to be a big evaluation time for casual dining coming up.
Yeah, I know you got some favorites in DRI and in Brinker as well, I think. We'll talk about why those two are special. And then in quick service, I wonder how much of that off-premise do they actually keep once we get to at least closer back to normal?
Yeah, when it comes to, just to pick on two names out there that have had big off-premise sales layers that have been added, it would be Chipotle and Chili's, which you don't normally put those two together. Brinker's Chili's business, 90% of Brinker. They added a tremendous off-premise sales layer. They were 20% off-premise before COVID. Now they're 50%. We'll see where that settles out. And if you're looking at the out-year sales, to say that they might be 15% above 2019 levels, not hard to get there if they maintain a lot of that off-premise business. Similarly, Chipotle had a lot of business through digital, and now they have the most loyalty members per restaurant in our coverage. When it comes to fast food, though, the funny thing is that the global multinational names, franchise names, those stocks haven't worked very much. And, to some degree, you wonder when they will get in the game. Obviously, vaccines have been slower to roll out overseas, but perhaps the best stock upside is in names like McDonald's or Yum Brands from here.
David, I mean, we've seen millions of workers in the restaurant industry laid off in the past year. In the midst of faster, perhaps, adoption of some of these digital technologies, automation, how many of those workers will again have jobs? And I guess when you are talking about that broader tech adoption, whether it is, as you just mentioned, McDonald's or others, what does that mean for the stocks themselves and the bottom line?
Well, the restaurant, you point out a good point, which is that restaurants are really going after tech right now. They've had a big wake up, having 90% of their sales at a typical drive-through format location. 90% of the sales have all of a sudden been going through that drive-through. So everybody's thinking about, do I have my mobile order set up? Ultimately, with $15 wages down the road, people are thinking about efficiency, and they certainly want to keep their franchisees as whole as possible. There is no clear job loss that's going to happen from digital. Rather, it's really about productivity and driving speed, checks, aggressive selling, all sorts of stuff. But down the road, much further down the road, that's something that could take the edge off of the employment or bodies needed at the restaurant. That's not the focus now. Everybody's just trying to get people through that drive-through more quickly, for example.
Speaking of that, David, it's hard to remember, but before COVID hit, I mean, it seemed like every other day there was some headline about menu innovation or new menu items, each player trying to outdo the other. And I would assume you think we're going to get sort of back to that environment as they start competing for this fresh wave of dollars.
In the fast food side, it's going to be the barbell again. You can feel all the chicken sandwich news, all the premium news that's happening right now. So you're going to see, you saw the quesadillas from Chipotle, you see all the chicken sandwich wars that are happening right now. And basically, that's going to be great for one side of the equation, but you're also going to need value. A lot of people have been left behind so far in this recovery. And so for that 20 to 25% of the fast food users that need value, that's going to be around. And right now, you're going to see companies, the big chains, they're going to have to feature value at the one end to go along with their premium chicken sandwiches on the other end.
Shepard Smith here. Thanks for watching CNBC on YouTube.